Hey guys, Red here with Section 8 Real Estate Investing. Thanks for watching. If you're new to the channel, don't forget to subscribe, like this video, leave your questions and comments below. I'll get to every single one of them. All right, put your seatbelts on, because right now we have a very in-depth topic that every single real estate investor should understand thoroughly, because it's one of the biggest tools to help you understand whether you're making the right investment, okay? And you've probably heard it a lot. Maybe you know what it is, maybe you don't, maybe you've heard of it, maybe you know about it a little bit, but we're gonna get pretty in depth with it here, okay? I'm gonna give you kind of a broad outline of what it is, why it's important, and what you need to think about as a real estate investor, okay? So here it is, capitalization rate or cap rate. You might hear a lot of times someone say, well, what's the cap rate on it? What kind of cap rate can I get from that investment? And we're gonna dive into that. But first, let's understand what cap rate is. A cap rate is the yearly net that a investment property produces, okay? So, for example, it's a net, meaning not what it grosses, what is the net income after all your expenses are paid, meaning taxes, insurance, property management, everything, okay? So what is the yearly net divided by the purchase price that you purchased it for, okay? So we can run what a cap rate is on a property before we even step foot into it, if we look at the financials of it. So for example, if I'm gonna look at an apartment building that I wanna buy, I look at all their financial statements, I see how much they gross every single year, I see how much of that gross is actually net, and then I divide that net by how much the property's worth, okay? So I gave you an example right here, and then that is the cap rate, okay? So I gave you an example right here that we can kind of run through together, very easy, very round numbers. So for example, say I purchase a single family rental, okay? I make $10,000 per year in net income, okay? And I bought the property for $100,000, all right? My cap rate is 10% because 10,000 divided by 100 is 0.10, which turns into 10%. Now, what does this percentage mean, okay? What does it mean? Well, if you then take this number right here in terms of this being 100% of your purchase price, you can understand how long it will take you to make your money back. Meaning, if it's at 10%, 10 years at this number will get my investment back. You just divide 100 by whatever this number is, okay? So in 10 years, I'll make my money back. Now, we'll do another one out, okay? To try and show you, if you didn't catch that, what I mean by that, all right? So for example, let's say I'm netting $33,000 per year, okay? My cap rate is gonna change a little bit, right? Because then we're same purchase price. This is a crazy good investment, okay? The higher this number is, the higher your return is. So 33,000 I'm netting per year divided by my purchase price of 100,000, right? It's gonna be 0.33, which equals 33%, okay? And then if we take that number divided by 100, I'll make my money back in 3 years, okay? Now, you can plug in whatever number here. You just divide the yearly net by your purchase price to get your cap rate, divide that number by 100 to figure out how many years it'll take to get your money back. Now, that's good to know if you're trying to make your money back faster. Now, let's get into some more detailed conversation with this, because cap rate isn't always what it seems, and I'll tell you what I mean by that. Well, there's a lot of variance that goes into cap rate. For example, maybe 1 year that apartment complex that I stole for 100 grand, that's creating 33,000 a month. Nobody would ever sell it to me for 100 grand. But say I have a really bad year, okay, and something happened in the area, and there's incredibly high vacancies, okay? So instead of making 33,000 that year, I only make, I don't know, what if I was operating at 50% vacancy? So I only make about $17,000 that year, okay? So then obviously this changes, right, to 0.17 to 17%, which is still crazy, crazy high, right? But still, it varies, okay? Maybe the next year I'm back up. Maybe I fill in another 25% of my units, which brings my, my net income to, 25,000, right? It's gonna change the cap, okay? Now my cap's gonna be 25. So this is always varying on your yearly net income, okay? So when you're buying investment property that already has tenants in it, whether it's an apartment building or a home, I like to see the financials from the past couple of years. That way you can try and find an average cap rate. I think it's a lot easier to find an average cap rate if you have the last 3 years of financials or 2 years of financials, if you can get them from the seller. That way it'll be you can make a little bit more of an educated assumption on what your cap rate is gonna be, okay? Now, risk. Let's talk about risk and how it translates to your actual investment, okay, and what that means, all right? Now, let me explain to you what I mean by that. Okay, so, for example, the cap rate, the higher that cap rate is, obviously, the higher your return is gonna be. In today's market with purchase prices so high, it's really hard to find properties that have very high cap rates. Now, when you're making a decision on an investment based on cap rate, there's a couple things you need to understand. You need to understand that in big, populous cities where there is a lot of desire to live, obviously that means that purchase prices are going to be higher. But what does that also mean? That also means that your cap rates are going to be lower, okay? So for example, let's do it this way. You want to buy a place in New York City. It's going to cost you $1 million, okay? $1 million as a purchase price. Now, for the year, you can still rent it out for $17,000, okay? Now what happens is, you're running the cap here on 1.7%, okay? That's a pretty dang low return, okay, on your money. Now, when I look at cap rates to decide if I want to buy a property, I base the cap rate on the appreciation of the investment. So for me, this would be a little too low anyway, right? So let's say for $1 million, this property is going to bring in, $50,000 a year net, okay? So that is going to be someone do that math at home? Yes, very good, 5%, okay? So that is 5%, okay. So we have here a 5 cap, this would be called. Now, 5% in cities like Boston, New York, San Francisco, that's kind of the going number, okay? This is what numbers usually look like, okay? That's what you're gonna find. So if we kind of go back to what we talked about earlier, yearly net purchase price cap rate, if we divide this number by our purchase price, or by 100, I apologize, by 100, we learn that, 5 divided by 100, 20, 100 really divided by 5, 20, we make our money back in 20 years, okay? Now, not great, okay? But not awful if you're looking at appreciation. So, lower cap rates, we want higher appreciation, right? Higher cap rates, we don't care as much about appreciation. For example, in New York City, this property that I'm buying for $1 million at a 5 cap in 10, 15, 20 years, the place might be worth $4 million, right? So then I've made a good amount of my money back, and I've really, really increased the value of that property I bought, okay? So when you're looking for appreciation, lower cap rates are fine. Now, granted, you still want to make a really good investment, but if I know that this property is going to increase a lot over the next, 10, 15 years, a lower cap rate's fine because my risk is a little bit lower. So lower cap rate, lower risk as far as appreciation goes. Now, if I'm going to invest in a property in, say, Birmingham, Alabama, which I have a lot of properties, right? 5% is nowhere close because in 20 years from now, I could buy a property right now in Birmingham for $50,000. And 20 years from now, that property might be worth 60 grand, right? For my properties in Boston, Mass, this is fine. I'm good with this because I know in Boston in 20 years, that number is going to be a lot higher, okay? Birmingham, I don't know that. So in Birmingham, let's run some numbers, okay? So we'll say I buy a property in Birmingham. We'll say $50,000. I buy a property in Birmingham for $50,000. Assuming I'm not going to get a ton of appreciation over the next, 10, 15, 20 years. But it brings me a yearly net of $5,000. Okay, pretty good. So, this is what the math looks like, right? Now, 10%, that's a pretty good cap rate, okay? So, really, anything in Birmingham, I'm looking for over a cap rate of about 8%, all right? Anywhere else where I'm worried about appreciation, I'm looking for higher cap rates, okay? Now, this is pretty good. I make my money back, in 10 years, and I'm making 10% every single year on my initial investment. Now, I'm still getting appreciation, but not the same appreciation, right? Because in 20 years from now, this property might only be worth $70,000. So when I go to invest in places where I'm worried about the appreciation, I try and get higher cash flow, okay? In Boston, I'm okay buying a place and renting it out, with a 4 or 5% return because I'm looking to the future. I'm looking to, the appreciation of that property. When you're worried about appreciation, you want to try and get as much cash flow up front as possible. Now, let me also show you about what happened years ago when I first got into this market, all right? As you guys know, if you've watched other videos, you know that I started in Birmingham, Alabama. The first home I purchased in Birmingham, I purchased for $33,000 all in, $13,000 up front, all right? This property cash flowed for $1,000 a month, okay? Pretty good, right? So we're at $12,000. The net on it was actually all in. We were 34 actually on it. I apologize. It was 33.5. So it was 34,000. We'll round it up, and the net on that investment per year. Okay? Pretty good. Now, I don't have a calculator, so don't, freak out here, but it'd be 3 before, 4, we'll say it was 36. Sorry, guys. Round numbers. Sorry. This right here, it would be 4, so it'd be 25.25. Craziness, right? I'm making my money back in 4 years. I'm dividing 25 by 100 is 4. I make my money back in 4 years, 25% cap, okay? When I started in Birmingham, these were the numbers I was getting on everything. I was capping out everything between 15 and 32.5%, which is mind-boggling considering what the market looks like now. But I was okay with that because in 10 years from now, 20 years from now, I was saying to myself, well, if that property is still worth $36,000, not great because I gained no appreciation, but my cash on cash return was so high, my cap rate was so high, I could sell this right now to an investor for so much more money, because this cap rate, if I told you as an investor, hey, right now a really good cap rate for Birmingham's 10%, I can, give you one with a 25 cap on it, right? Now, you're not gonna do that, obviously. You're gonna reflect the purchase price down to 12, 13, 14% to say, hey, Mr. Investor, going rate's 10%. I'll give you something that's 14, 13, 15%, right? So you get paid more for it, and you've reaped the benefits of all the cash flow. So it can be confusing at times, but that's basically what cap rate is and how people make decisions based on cap rate, okay? I'm sorry if I lost you along the way. It can be a little confusing. Continue to read up on it. Continue to try and understand cap rate. I know this video is not going to do it all for you. You have to learn. You have to do it yourself. You have to do it with real numbers that you find. But the more you do it, the more you'll become comfortable with it, and the easier it will be for you to try and dissect deals just by looking at them before you dive in. All right, guys. Thanks for watching. Leave your questions, comments below. I'll get to every single one of them. We'll see you next time.